So now we will discuss about the third method of the measurement of national income, that is national income by expenditure method. Um, Factor income earned by the factor of production is spent in the form of expenditure on purchase of goods and services produced by firm. That is expenditure method. This method measures national income as sum total of the final expenditure incurred by household, business firms, government, and the foreigners. This total final expenditure is equal to the gross domestic product at market price. So this method is also known as income disposable method. So what are the components of the final expenditure? Expenditure is undertaken by all the sectors of the economy: household, government, firms, and the foreign sectors. The various components of the final expenditures are that private final consumption expenditure. It refers to the expenditure incurred by the household and the private non-profit institutions serving household on all types of consumer goods, that is durable except house, semi-durable, non-durable goods and services. Next is government final consumption expenditure. It refers to the expenditure incurred by the general government on various administrative services like defense, law and order, education, etc. Government produce goods and services with the aim of a social welfare without any intention of earning profit. Next is gross domestic capital formation or gross investment, you can say. It refers to the additional to the capital stock of the economy. It presents the expenditure incurred on the acquiring goods for investment by the production unit located within the domestic territory. And then we can discuss about the net export. So it refers to the difference between the export and import of a country during a period of a time of 1 year. Export X refers to the expenditure by foreigners on purchase of the domestic product. The exported goods have been produced within the country domestic territory, so they are also included in the output of an economy. Next is import. Import shows by the capital M is an expenditure by the residents on the foreign products. Import are deducted to the obtained domestic product as they are not produced within the domestic territories. Instead of treating export and import separately, the difference between the two taken as a term of net export means when export minus import, so the figure that will come, it is called the net export. So that is the thing. Now we will discuss about what precautions we have to take when we are using the expenditure method. Expenditure on the intermediate goods will not be included in the national income. If we include it, then it will lead to the double counting of expenditures. Next is a transfer payment are not included because such type of payments are not connected with any productive activity, they are on the value addition. Next, purchase of second-hand goods will not be included because they have already been included when they are originally purchased. Purchase of the financial estate assets. Purchase of financial assets means will not be included as such transaction do not contribute to the country flow of goods and services. These final assets are merely paper claims and involves in the change of the title only. Expenditure on next is and the last expenditure on the own account production. like protection for the self-consumption, imputed value of the owner's occupied house, free services from the general government and the private non-profitable institutions serving household. It will include all the national income. So now we will discuss about our next point.